Welcome to Lickin' on Lending, the podcast that dives deep into the heart of the mortgage industry. Your host, David Lickin, bringing you the latest insights, trends, and updates from the world of mortgages. Whether you're a seasoned industry veteran or just getting started, this show is your go-to source for all things mortgage. Let's get started. This is Lickin' on Lending. Now your host, David Lickin.
Listeners, there is a lot going on in D.C. and with this administration, and we're now starting to get some indication they're focusing in on housing, and specifically Fannie, Freddie, and a lot of news that's coming out, $200 billion of buying. But are they getting to the sweet spot? Are they getting to the areas where that could make such a difference? Well, our guest today, Philip Bracken, who is is with Falcon Capital Partners. He's the vice chairman of Falcon Capital Partners, located in Washington, D.C. They're a strategic advice, technical expertise, a lot of advocacy support. If you go to their website, you'll find some of the names of the who's who of the previous administrations. And Phil has been there and has done so much in so many areas. I was going to have David Kittle join us today. Unfortunately, he's having some other technical issues in other areas. Those four wheels he runs around on blew up on him today, so he can't join us. But Phil, it's good to have you here, friend.
Thank you, David. It's great to see you again, and happy to be here to provide a little insight about all this stuff that's happening. Not easy to solve, but boy, we have plenty to chew on.
But there are. Yeah, but the fact is there are solutions, and this is what we're going to be talking about. There are real practical solutions. You've published a white paper that we're going to put in and make available to our listeners that listen to it. I encourage you to go to our website, Lickin' on Lending, go in and look at specifically this white paper in our show notes from today's podcast. But let's first of all establish for our listeners, Phil, we have so many new people to the industry. 3.7 million listened to it in the last 30 days. There are so many new people that do not know who you are and your background, nor your firm's background. If you can give us a little bit of your backgrounds and the firm and what you're doing and why you have the audience you do with the White House, and then we're going to get into the plans that you have.
Yeah, thanks, David. Primary background was mortgage banking, traditional mortgage banking. I was the managing director of Prudential Home Mortgage, and which we sold the operation after a number of years to what was then Wells Fargo, and I became a managing director, EVP of Wells Fargo, and I asked to be allowed to take over the government relations for the mortgage unit, which no one would ever ask to do, but I just felt like that it was essential for one of the practitioners in the marketplace to be able to interface with policymakers everywhere to provide practical solutions to the issues at hand. I'm glad I did. I spent a lot of time there. I retired from Wells Fargo in 2011 to start a nonprofit organization called America's Homeowner Alliance. It's the advocacy organization for the 80 million existing homeowners and everyone that's aspiring homeowner as well. Feel free to look that up if you wish.
We'll put a link to it. Listeners, go check out the link at our website. Send that over so we can make sure we get that.
Will do. And took a couple of other assignments before I joined Falcon Capital Advisors. My current organization, I am the vice chairman. Our chairman and founder, Armando Falcon, was the former regulator of Fannie Mae and Freddie Mac, and before that was the general counsel for what was then the House Financial Services Committee. Armando is well grounded in Washington. This is our 18th year of operation at Falcon Capital Advisors, and we do business operation work for private sector clients, government clients, etc. All of it is housing related, and we have a really strong penchant for figuring out solutions to provide opportunity for the underserved population of America and for the institutions in the entire ecosystem that struggle every day with just trying to make ends meet with federal policy overhanging everything they do. It's not a simple or easy environment, but that's why we're here to help. And I think we've got some solutions. You mentioned before the paper that I just wrote, and yes, we would make that available to all of you. Let me just maybe a couple more comments, David, before we move on. We know that we're in a really challenging environment. It's not just
We are.
it's not just the demand side of the equation where people are experiencing affordability issues and credit access issues, product issues, etc. But it's a challenging environment, much different than anything we've experienced because of the crisis of the impingement on single-family homeowner access to inventory. And when you find a
Yes.
imbalance of supply and demand like we're experiencing now, property values increase dramatically, and people just don't have access to choice and opportunity. And we've got to get to work to fix that, to solve for that. And that's what this podcast is about. It's hopefully going to give you some practical solutions about what we might do to solve the inventory crisis.
Right, and and there's a number of areas which you can do that. Again, when you have prices going up, it exacerbates the problem of affordability, housing affordability. It just exacerbates the problem. But you've actually put together a paper that has it gone to the White House or being submitted to the White House?
We've sent it to not only the White House, but to other important policymakers in Washington because there are solutions, and many of them don't require legislation and regulation. It just
so it could be done through executive order
and or just business practice or government operational change that doesn't require legislation or regulation. There's a lot of really important solutions that are practical that could be done, and we'd love to dig into that today with everyone.
Let's get into that. Something right there, because one of the things you have given us is some truth serum about the housing and the inventory. The problem seems nearly insurmountable. We've all talked about that. Been so much said, but very little done about it. The magic question is, what can be done about it? And that's what that paper addresses. And I really like to dive into that now.
Thank you, David. Well, I felt that maybe I would take a practical assessment of if you were tasked with the responsibility of drawing up some solutions for the inventory crisis, where would you start? And I divided the inventory issues into 4 separate categories. The first is new construction, and I'll address that. The second is existing inventory of properties that people own and should be listing for sale, but they're not going to trade out of a 2.5% mortgage to go get a 7.
Right.
And the third is rehabilitation of property that needs repair, fixing, bringing it up to code, etc., before it can be made available to consumers. And the fourth one is conversion of commercial buildings to single family. That in every city in America has 1 or 2 examples of high-rise facilities that are vacant or dormant and could be renovated or retrofitted for single family. So those are the 4 areas, and love to dive into them one by one because I think there are.
Yeah, let's do that. So let's start with the first one, new construction.
Okay. So let me a little bit of history for our listeners. During the Great Recession of 2006 to 2012, everyone knows that we went through a really bad cycle in America. Towards the end of that cycle, the Census Bureau in America produced a report that indicated there were 10 million single-family vacant properties available for sale in the United States.
10
million single-family vacant properties in 2010. That because the financial regulators, the bank regulators, were stunned by the magnitude of that size of that inventory, the bank regulators made the decision to change the regulatory and the capital and reserve requirements that banks would make for builders to build more houses. Obviously, it was done to curtail building more homes when we already had 10 million in place. Essentially, the banking regulators doubled the capital requirements and doubled the reserve requirements for builders that were building homes and had big 1,000-unit developments in plan. And it really did reshape the marketplace. About half the builders in America from 2008 to 2012 went out of business. And much of it was because they just
I wasn't aware it was that
simply couldn't meet the new capital and reserve requirements that were imposed on them when they borrowed money to develop, acquire land, develop it, and construct property on it. Those are called acquisition, development, construction financing loans. And it made them, almost so expensive that they just simply couldn't afford to complete that building. Unfortunately, here we are, 2026. Many of those regulations, the regulations that were imposed on banks that made those kind of loans available to builders need development financing to be able to build subdivisions, etc. Many of those impositions, those changes, while some have been relaxed, they haven't been modified to stimulate more building. And that's one of the big things that needs to be done. I think if you look at the National Association of Home Builders website, you'll find that the cost of acquisition, development, and construction financing is still so prohibitive that builders simply can't build low and affordable properties. They have to build higher priced properties to build in those profits. It's a problem, but that's one of the things that could be addressed rather quickly. To stimulate more building of affordable single-family homes, the regulators could easily change to incent the behavior for builders to develop more affordable properties. They could provide a relaxation of those standards. And I want to say this in the context that no one wants to go back to the Great Recession. We're not looking for...
No, and you're not suggesting that.
No, not at all. But clearly, there needs to be... I don't know any place in America that's really overbuilt, so we have an undersupply. In fact, the National Association of Realtors estimates we have about a 7 million unit undersupply. The home builders undersupply estimation is not quite that big, but whether it's 2 million or 7 million, we are way underbuilt in America of the affordable supply.
Even when we have the 10 million homes.
They're all absorbed. All those have been absorbed by now, and we now have this undersupply that is really driving up house price.
I was going to say I thought that would have been the case that had been absorbed. Let's move over to existing construction. First of all, I want to finish up on the new construction. David Kittle, who again wished I could have been joined on this podcast, who we want to give the credit. He's the one that actually introduced having you on the podcast. I've known you for years. Very honored to have you on here, Phil. You're well established. But it was really Kittle that said, Dave, we got to bring this to the forefront. You got the biggest podcast in the mortgage land. Let's get this out so we get more people supporting Phil and what he's doing. But Kittle had on at TMC and interviewed the head of the Builder Association, and they talked about what stood out to me is the cost of regulatory cost that goes into building a home. In San Diego, it's 60% of a new home was the cost of construction.
Well,
we have got
David, let me just I want to make sure everyone understands this statistic. The average regulatory and compliance cost to build the average home in America is $94,000 per house.
Are you serious? I did not know that
per house across America. We are not going to have affordable housing if a builder knows that before they put the shovel in the ground, they're going to experience $94,000 of regulatory and compliance cost. And by the way, there is a way to solve for that. If I were setting the rules or the priorities, I would create a commission in Washington charged with the responsibility of evaluating why in the world do we have $97,000 of regulatory and compliance costs, and give them the incentive to cut that cost in half by the end of 2026. And if they're really good at it, we reconsider reestablishing that coalition for the next year to cut them in half again. And many of these costs can be cut. There is no reason for that kind of excess cost for regulatory and compliance.
That's a staggering
number. And I want to emphasize, it's not that builders don't want to build affordable housing, but my God,
no.
If you're a regulatory,
they can't afford to do so,
and compliance
doesn't make economic sense.
Are that high, that it just. Let me move on to two other quick things. One of the other things that builders are experiencing today. It is what it is. Let me start by saying this before I make this next comment. I think everyone in America is proud and happy that we have a much more secure border in America. Yeah. But one of the tribulations of that is there are 260,000 open construction jobs in America right now. 32% of the construction workers in America are Hispanic, and we have an undersupply of available labor and tradesmen in the marketplace. And again, a simple solution, and I don't know all the background or protocol, but if we had a really robust immigration plan, a visa program for construction workers that were vetted and established, and really good, labor construction workers, we could help fill many of those jobs. And you know what happens when there's 260,000 open jobs? The labor cost for those people that are working on the jobs goes up materially, and that adds to the cost of a home. And one last thing, you can go on the NAHB website, and I think it's posted there.
National Association of
Yes,
Home Builders.
yes.
Yep.
We're in an environment now where we're using tariffs as a way to stimulate more revenue for America, but those come with a cost, obviously, and the home builders have indicated that the same home without the tariffs is with the tariffs is now almost $11,000 more expensive than before the tariffs. That's their assessment, not mine, but certainly tariffs will have an impact. So if you think about acquisition, development, construction financing, the regulatory and compliance cost, the labor marketplace and the solution, and the tariff issues, that's a lot of the issues for new construction in America, and many of them are solvable without legislation or regulation.
Yeah, great point. Yeah, well, you've outlined it well, and so many of our listeners are bringing their hands saying, what can we do about that? I want to get to coming back to revisiting what you're doing in your plan, but let's move on to existing inventory.
Yeah, sure. Well, there are, millions and millions of people who have mortgages in America, somewhere around 20 million consumers that have a mortgage under 3% interest. And you know what that means for most people when the Federal Reserve, using its emphasis of quantitative easing from about 2008 to 2022, the Fed drove down interest rates, the Fed funds rate, and effectively mortgage rates following it. Mortgage rates drove down to 3%, and they did it to stimulate the whole enterprise of America, that whole model was called quantitative easing. In 2022, the Fed reversed policy in what I call quantitative squeezing, and started raising interest rates
hadn't heard that. That's a good way to look at it. Yep.
And raised interest rates 11 times in 18 months from the middle of 2022 to the end of 2023. And all those people who had mortgages of 2.5%, 3%, found themselves, woke up 18 months later staring at a 7% interest rate environment, or maybe a little higher. And they certainly, if they had any indication of wanting to list and sell their home to move into a different property, they weren't going to trade out of their 2.5% loan to go get a 7. It really did landlock, millions of people. I don't know that all 20 million would have wanted to list and sell their home, but even if we had 1 million of those people. So let me give you what I think is a easy, simple solution for that. The Federal Reserve also bought most of the mortgages that were produced from 2010 to 2022. Loans that were produced by banks and lenders across America that were sold to Fannie Mae or Freddie Mac or put in Ginnie Mae securities. The Federal Reserve bought a great share of those, if not most of them, and still have many of them on their balance sheet. I've just heard, and I'm sure many of you have heard, the president say that he'd like to have Fannie Mae and Freddie Mac buy $200 billion of mortgages. I assume that he means and put them on their balance sheet and maybe have some discounted rates for that. I have a little different solution. It's a little bit of that, but maybe goes a little step farther. Since the Federal Reserve already has on their balance sheet most of these mortgages, the Federal Reserve could stand up a specified pool of mortgages right now for existing homeowners that are desperate to list and sell their home. And if they were to list and sell their home, let's just say property's $500,000 and under, if they were to list and sell their home to an owner-occupant, the Federal Reserve would make a matching interest rate mortgage program for the existing consumer that owns this property that won't sell it because they have a 2.5% loan. The Fed already has the 2.5% loan on the books. They could match that interest rate on that person's purchase of their next home and would make, 500,000 or 1 million new properties available for sale. And matching that interest rate is just a swap of collateral. They already have the interest rate risk on the balance sheet, so it's just trading out of one home into the other. The consumer that would need to purchase those 500 new listings of property would have to get a prevailing rate, mortgage interest rate, but there are millions and millions of consumers standing ready to purchase homes. They just can't find one to buy. Adding that to the new inventory would be a real boom, and you can imagine how many jobs would be created from that, et cetera, and increasing the tax rolls for cities, workforce development, housing, and all of that. There's really a great stimulus opportunity to encourage the Fed to do something like that.
Yeah. Well, there's existing inventory, but then within the existing inventory, there's also a whole lot of homes that need to be rehabbed. I mean, the rehabilitation opportunity, and I'm thinking of many of our inner cities where they be dilapidated, they just run down because there haven't been incentives to revitalize those communities and the homes in them. What are your solutions for rehabilitation of the older inventory that we do have?
Yeah, great question. And obviously, it's the third pillar of this stool. I was fortunate to be the chairman of the corporate partners of the National League of Cities, the 35,000 cities that make up that organization, for a number of years. And I realized that cities in America own millions of single-family homes that they take back for delinquent taxes or eminent domain or seizure for some other reason, etc. And these cities just don't have the funding to be able to rehabilitate these millions of properties in their communities, to bring them up to code and to make them habitable for a consumer. So many of these cities have restrictions that in order to transfer property, the property has to be brought up to code to make it habitable, or they won't get an occupancy permit. So I've been thinking about what would be a real easy solution for, let's just say, 1 million single-family homes that would be affordable and accessible in the urban communities of America. I think you kind of have to be, I'll call myself a seasoned near fossil to be able to remember these programs. But the FHA has a program called the 203K mortgage program. The obscure provision that hasn't been used for years, maybe decades, there is a provision where a municipality and or a nonprofit organization could obtain a 203K mortgage as if they were the owner occupant.
Yeah.
Obtain the 203K mortgage. The mortgage is done with the rehabilitation costs already factored into the end mortgage. The money for the rehab is put into a escrow account when the inspection.
Right. Similar to a construction loan.
Yes.
This is where it has some similarities to the construction home, but we have to get past some of the regulatory regulatory.
Well,
hurdles.
in this case, there is a provision on the books where municipalities and nonprofits could obtain a 203K mortgage, and yes, maybe there would have to be some minor tweaks to the program to actually make it viable for cities to do 10 or 12 of these at a time. But nevertheless, these mortgage loans could be made available to the city. The funding could be made available to rehabilitate the property, bring it up to current standards. And the beauty of this program is once these mortgages are completed and the property is completely rehabilitated and an occupancy permit is available for a consumer to take this property, these mortgage loans are assumable. So by owner
really?
occupancy.
That's right. I forgot the 203K. We used to use 203K back in the day, many years ago, and I remember that program quite well.
Yeah, and that would make such a major difference in the cities of America for workforce development housing. And I don't have all the answers about it, but I know that if we just explored this a little more deeply, we could find solutions utilizing the 203K program. And just think, what would it look like if we had another 500,000 or 1 million rehabilitated single-family homes on the market? That would be a massive benefit to the inventory.
Well, not only that, what it would do for a lot of the inner cities, it would revitalize them and bring them back to life, where young families are wanting to move into there, where they have been exiting some of those communities. I love that idea. Are there any other programs other than the 203K that you're aware of that you would recommend in your solutions?
Well, why don't I just say, David, I haven't had the chance to do a lot more exploration, but if we figured that one out, that would be a massive.
And we just worked that one out. That's
let's
a good
start
one.
there, and we can go to the others. There are some other available opportunities, but that's a big enough one to try to tackle.
Oh yes, absolutely. Let's get talking about another. It's a problem and it's a solution. It's the commercial real estate segment, where there's so many commercial buildings, downtown cities, where people love to live. I mean, the young, especially the younger crowd, even older people, want to go in and it revitalizes again the inner part of the city, the old commercial districts that have gone seriously south or very vacant. Talk about the conversion of commercial real estate. What is involved in this? This seems daunting to me. This is one where it's a huge opportunity, but I got to tell you, the problems and the headwinds for that seem daunting.
And I don't want to mislead anyone that the headwinds are daunting in the conversion of commercial to residential. And just think of any city in America where there's a high-rise building, a 15, 20-story building that's darn near vacant or maybe completely vacant. And, workers are now working from home and not going back to these facilities. And you can find those facilities in almost every place in America. And the reason that I made one big suggestion about this, I really do think that this requires a task force, a commission to study lots of this is local marketplace zoning and ordinance problems that challenge the conversion of these properties. But yeah, I listen. I've been in many of these buildings in many cities of America, where there is an elevator system. There's a bathroom, facility on every floor, so they have water. They are compartmentalized into what could be carved up into condos or townhomes or apartment homes. The infrastructure is as solid as can be. It's safe, sound, and sustainable, and we just don't have the impetus to convert these to single-family properties. That is going to take more work and more study. But I can give you some examples. There are a few going on right now in Washington, D.C. and Chicago, where there are conversion of commercial buildings to residential. And it's not simple or easy. I don't want to imply that it is. But just think, if you every city said, I'm going to stand up a task force to do this, and I'm going to apply a little funding to this task force to create these solutions. By golly, in every place in America, we could build high-rise or convert these buildings. And while I don't have a specific, identified solution, I didn't want to pick one city because it's everywhere. David, if you add all these together, the solutions for new construction, the solutions for incenting the existing inventory to existing homeowners to list and sell their homes, the rehabilitation of single-family homes that are in the urban marketplace, and it doesn't have to be urban, it could be rural as well, and the conversion of these properties, if we focus attention on this, there are solutions. And, I'm just a commoner trying to think of what do we need to do to incent the right behavior. And if we really, America is just fabulous at figuring out solutions. And if we all start pulling together and we build some solidarity around this, I bet you we can figure this out and solve this inventory problem that would really help solve the price of affordable home ownership in America.
Well, the paper you've turned out and written and prepared is a great start on helping guide this process. And I think it is going to have to be picked up at a grassroots level and picked up. And that's an opportunity for anyone listening to this podcast. What can I do to make a difference? A lot of us get overwhelmed by a lot of this. We have guys like Phil, listeners, that are available to us who help guide us through this. He's brought up the 203K, that dust that old program off, bring it out. How about if we met with Scott Turner at HUD and started exploring what other programs are available? There are other programs available within HUD. I remember them as you're starting to dust some of those old programs off I used to do. But there's so many initiatives. And then also like the inner city and some of the bill. When we start getting together and just bringing together at a coffee shop or at a church, just say, let's get together and discuss this. When you can do that, and we have resources like you, it gets exciting. What are some of the other things you're working on? For example, I heard you talking about the impingement opportunity for aspiring homeowners. That's a great phrase. Talk about that and maybe another topic for a podcast. We've gotten here a good amount of time already we recorded, but what's your thoughts on the impingement opportunity for aspiring homeowners? Thanks
for asking, David. It's not a secret. It's not, everyone in the ecosystem of housing and housing finance in America realizes that it's harder for consumers to get mortgage access today than maybe ever before. In 2024, there were fewer single-family homes sold than any time in the last couple of decades. That just tells you the story of how challenging this environment is. And part of it is credit access. When I say that, not just credit, but just credit policy. I'll give you just a short example. And I'm not pointing fingers here. This isn't pointed at this administration or the previous administration. This isn't a political statement. It's simply just a statement of fact. You know that the FHA Mutual Mortgage Insurance Fund operates with a traditional benchmark of 2% of the loans or mortgages outstanding need to be covered by the basis of the insurance, the foundation of the Mutual Mortgage Insurance Fund. And that benchmark 2% indicator has been the common thread for whether we are safely reserved or not. The fund is currently operating at about 11.47%. It just feels over-reserved for the environment that we're in. I don't see housing prices declining anytime materially soon, and that's basically what the risk is built on. Yes, I don't know that we need to get it all the way down to 2%. That seems like a pretty big drop.
Bit of a fantasy, and not even practical.
But somewhere in between there could be space for, and part of that is the upfront insurance premium that consumers pay when they get an FHA mortgage, and those premiums. There should be a way to evaluate whether we're, over reserved in that fund, and maybe there could be some.
Well, we are. I mean, 2%, and we're at
11.47. Right.
Yeah. Maybe that is ridiculous that we've gone that far. We should be converting those funds to that. What is it? What are your recommendations, or what people could take away from this podcast? Number one, reach out to you and to your firm and start doing that, getting behind you. How does the MBA play into this? I know they're advocates as well. How do you guys work with the MBA, and how's that?
Well, it's interesting. Maybe I'll start before I respond about the MBA. I co-chair an organization. This is my 21st year of co-chairing an organization called the Consumer Lender Roundtable in Washington. It's the most,
I heard you talk about that.
12 of the most influential consumer groups in America. And as most people know, these consumer groups weigh in on everything from, transportation to healthcare to housing, and they do matter. They have immense influence on housing policy in America. This organization is called the Consumer Lender Roundtable, and we meet once a month. We have for 21 years in a row. We dissect housing issues and housing policy. It's not only the 12 consumer groups, but we have 10 of the largest lenders in America in this group with us as well. And that's where we vet many of these challenging issues to discern whether or not we're off base or on base, etc. We do the same thing with the MBA and the National Association of Home Builders and Realtors, and I'm thrilled to say we do that as well with the 3 diverse segment real estate groups, the Asian, the Hispanic, and the African American. It's desperately important to have interface and input from them. And let me give you the reason why. If our listeners haven't seen the Urban Institute report or the Harvard Joint Center for Housing's demographic study of new household formation forecast from 2025 to 2035, I'll just tell you what the answer is. And I do have this in one chart. Happy to send it to you, David. 100%, and you got to listen to this correctly, 100% of net new household formation over the next 10 years, 2025 to 2035, will be people of color. It's Asian, African American, and Hispanic. A majority of those are going to be Hispanic. But the point being, if you know that that's the demographic standing in front of you over these next 10 years, we better start building housing policy to meet that need, because that's where the economics are, and that's where the need is at as well. I'm not saying we don't have policies to meet there, but boy, we need to really emphasize those. And that's why the emphasis of the inventory crisis solutions and the access to the underserved market for home ownership, there are solutions coming for that as well. And that's the next thing that I'm working on tackling, how do we get more access to the underserved population of America. But before we dive much deeper into building more demand, we better start finding solutions for this supply.
Yeah, we absolutely do. I want to put a word in and say thank you for your work with the National Association of Hispanic Real Estate Professionals, NAHREP. With Gary and the group there, you're on the corporate board of governors for that, and you serve in so many areas. You're a wonderful resource to anyone wanting to do this. How can people reach out to you and get you to speak to their organizations or bring you in to influence their municipalities on any one of these four key pillars?
Happy to entertain any inquiry, David. My email address is pbracken, BRACKEN, pbracken at falconcapitaladvisors.com. Feel free to reach out anytime. And this does require solidarity. We need everyone really rowing in the same direction about finding solutions to this inventory crisis, and then more solving the demand issues as well. It's still the best housing market in the world.
It is. We have the best housing market system, but we have not solved that. Of all of that concern, we have not solved the affordability issue and the access to, especially for first-time home buyers. We've got to get that solved. I'm so grateful. So grateful for you to come on. I'm grateful to David Kittle. I want to give him a major shout out. I'm so bummed that he could not be here with us and join in on this discussion today, but I'm so grateful that he inspired it and brought you back, you and I back together. And I'm so looking forward for our wives to get together and talk more about this over a good glass of wine, my friend.
You got it, David. Thank you so much, and thank you to the listeners. Onward and upward for a great 2026.
Yeah, and there are solutions, listeners. There are solutions. Start the dialogue in your community. Get a hold of Phil. If you need some talking points or even his support, he'll come in and help you.
Thank you, David.
Phil. Folks, I hope you found this podcast interesting. It is one of those topics that we need to be sharing, and I encourage you to do so. This podcast is made possible by as a result of our sponsors, Title Ease, Byte Software, First Close, Angel AI, True, Candid, as well as the Mortgage Bankers Association of America, Lenders One, Modex, Redder, Mortgage Advisory Tools, Fuel, and of course, we are so grateful for you, our listeners. Take this, circulate it around. Let's get this to be one of the most listened to podcasts. It's an important topic. We've got to solve this problem. Have a great rest of your day, rest of your week. Look forward to seeing you back on another podcast soon.
You've been listening to Lickin' on Lending. Our passion is to bring you the latest insights, trends, and updates from the world of mortgages. So on this show, if you're a seasoned industry veteran or just getting started, it's your go-to source for all things mortgage. We hope you've enjoyed the show. We'll be back soon. Take care, and we'll see you next time on Lickin' on Lending.